We've been really in like a 50-year debasement trade. When you could buy silver in the teens, I view that as pretty asymmetrical because it's hard to really kind of structurally go much lower than that. That I think that the broader crypto space, there's like $1 trillion in market cap in the broader crypto space outside of Bitcoin. And I still think a lot of that's overvalued. We're entering a more multipolar world. I've been writing about that since at least 2020, probably, somewhat before then. We're entering a world that's centered, partially around the US, partially around China.
Huge sell-off in commodities and market rotation happening right now on the 2nd of February as silver had its worst single-day drop since 1980. It's now down 40% from its top on January 26th. Meanwhile, gold is down something like 20% from its top in January. So what is next for the metals? What is next for Bitcoin? Bitcoin is also seeing a huge sell-off today, while stocks, on the other hand, are holding up quite well. What's next for the Fed and monetary policy after Kevin Warsh was nominated for the Fed chair? Next, Lyn Alden, founder of Lyn Alden Investment Strategy, is back with us to dissect what's going on in the current market action and what is next with stocks, metals, Bitcoin, and much more. Lyn, welcome back to the show. Good to see you as always.
You as well. Always happy to be here.
Let me just start with this tweet that you made. So the Happy Hawaiian, has gold ever tanked 9% in an hour before? This was January 29th. When things trade like a meme coin to the upside, they are also at risk of doing so to the downside. If gold is a meme coin, then I guess silver is what you may call a super meme coin, if there is such a thing, because silver is down literally 40% from its tops just a week ago. So then the question is why this trade is happening right now. Previously on your newsletter in December, you talked about the debasement trade happening in 2026. We'll talk about that. I wonder if that's still in, because in the debasement trade thesis, you had called for gold and silver and Bitcoin to do well, and you have been so far correct in 2026 for gold and silver. Now it's starting to unwind, and you kind of called this unwind on Twitter last week as it was just about to happen. So just tell us from a macro perspective why this is happening right now.
Yeah, good set of questions. I would separate these two concepts, the debasement trade and then this specific action in precious metals. And one of the key takeaways I had in my debasement trade newsletter piece, so I called it the so-called debasement trade. And I was being a little sarcastic about it because that was like the new term that people were talking about. And my main point there is that we've been really in like a 50-year debasement trade. And that, outside of COVID, there's not really a ton more happening now debasement-wise. We are in fiscal dominance, so the source of debasement is more tied to fiscal deficits than it is to bank lending. So there's been an inversion of that. And so some of the underlying mechanisms change over time, and interest rates kind of lose their effectiveness in some ways. But so basically it's saying that we're still in the debasement trade that we've been in for quite a while. And so as it relates to precious metals, my view, so I've been bullish since 2018 on gold, silver, and platinum. For a while, platinum was kind of the dog of the portfolio, kind of going absolutely sideways for a frustrating number of years. Sometimes predicting the time in these things it can be surprising. So, for a while, I was calling for gold to hit 3,000. And if you asked me, would it hit 4,000 and 5,000 in such a rapid, short period of time after hitting 3,000? It wouldn't have been to my base case. Same thing with silver. I was looking to see $40 and $50 silver. I would not have guessed we'd touch $120 silver not that long after. So the rocket ship that these things went on was remarkable to me. So they've crashed down to levels that are still above a year ago. If you asked me what I think they'd be right now, right? So when assets go vertical in price, when these things are soaring, everybody on Twitter X is just talking about it. Everybody has opinion about either the top or that the idea that it can double again. But everyone's talking about it either way. That's when risk is super elevated. I mean, relative strength indices, like in measuring overbought status, about as high as you get with these things, or really almost any asset. And so whenever you have that kind of extreme upside potential, you risk extreme downside potential. It's kind of washing out momentum, euphoria, sometimes leverage. Right now, I think you want to see the dust settle because these things have such a wide band that they can trade in because, we talk about these being multi-trillion dollar assets in terms of like their kind of estimated market cap that's above ground refined gold and silver. And that's true, but a fairly small amount of trading volume can really kind of dramatically change the price if traders get too much on one side versus the other side. So I think the trade got over its skis. Long term, I think, I don't think this was a bubble in the sense that I don't think, they deserve to be low, they soared up, and then it's purely a bubble and they're going all the way back down. But I do think that they got over their skis. The way I've been describing it is I think they've been structurally undervalued for a while. They finally got kind of the recognition that they deserved. I think they've kind of traded back up closer to fair value, but now they're less asymmetrical. So when you could buy silver in the teens, I view that as pretty asymmetrical because it's hard to really kind of structurally go much lower than that. But as you've seen, there's plenty of upside potential. And the same is true for gold and platinum, to varying degrees. But when you've already soared quite a bit, there's both upside and downside potential. I was on a podcast maybe a month ago or so, a while ago. I think silver was like 60 at the time, and they said, "Well, what do you think's first, $40 silver or $100 silver?" And I said, "I literally don't know. When it starts to go up that quickly, it can go either way." But the point is that when you already have gone that quickly, that asymmetry is gone. So the fact that you don't know and it becomes a coin flip is part of the risk compared to when you could buy it much cheaper.
Let's take a look at the charts. It seems like gold may be responding, maybe, I'll let you comment on this, maybe responding to some violent action in the dollar as well. The DXY had a rapid rebound, and you tweeted about this before it rebounded. A breakdown in the dollar and seems pretty intentional. Many people will sensationalize it, but it's still in the longer range for now. In its longer range for now. Sub 90 gets interesting. This was posted on the 27th of January when actually at the time it was at its then low. So you posted that at the low of the DXY. Since then, it's been rebounding back up. And coincidentally, gold and silver have been moving in the polar opposite direction, which you would expect, gold trading inversely to the DXY. Help us explain this pattern, Lyn.
Well, so on average, they tend to move inversely. Obviously, you can see from your chart, there's other variables there. They're not perfectly inversely correlated.
Sure.
I think the main underlying issue here is likely tied to the nominee of the next likely Fed chair. President Trump has selected who's widely considered the more hawkish pick among the various picks he could have made, both in historically in terms of interest rates and also recently in terms of say recommended balance sheet size by the Fed, and that can affect things like liquidity. Now, there have been kind of pushback on the idea that he'll be super hawkish because he's also talked about how AI-driven technology can create kind of productivity deflation, which allows for lower rates. So he probably won't be as hawkish as he was in the past. But it's certainly among the candidates that could have been selected. At least his historical track record leans on the hawkish side. I think that spooked markets a little bit. I think to some extent the market was kind of pricing in the idea that they'd have a Fed chair that just does whatever Trump wants, kind of like a super dove in a sense, kind of a breakdown between Treasury and Fed independence. And I think what they got is they have a somewhat more serious candidate that still might operate monetarily as they've kind of done in the past, which means some degree of independence, some degree of kind of data dependence, as they like to say, and that they might not get as dovish as kind of the extremes that they might have been pricing or might have been expecting on the far end. But I think that's probably the main variable for, and I don't think that's novel insight that we've seen, sell off in precious metals, sell off in Bitcoin, jump in the dollar from these low levels, timing wise tied to this more hawkish Fed nominee.
Before we continue with the video, a quick note from our sponsor today, Coinbase. If you're in Canada and interested in crypto, Coinbase is one of the simplest ways to get started. They are the first international exchange registered in Canada, and they follow the same regulatory standards you would expect from a publicly traded company. You can buy and sell more than 200 coins in seconds, and funding through Interact e-Transfer or EFT has zero fees. If you prefer a long-term approach, Coinbase also supports staking on selected assets. You can earn rewards directly inside the app without needing a wallet or advanced setup. and you can pause anytime. For traders, Coinbase Advanced is available at no extra cost and offers TradingView charts, real-time order books, and spot or futures trading with competitive fees. Create your account today using my link in the description or scan the QR code here and get $10 Canadian in Bitcoin for signing up. Yeah, and at the same time, Trump joked at a conference or a press event 2 days ago that he would sue Warsh if he doesn't lower the interest rate right away. So you're going to nominate somebody and then maybe threaten to sue him if he doesn't do what you ask him to do. This is a joke, of course. I don't think he's actually going to do that. I don't know. We'll see. But the point stands that the market still believe, like you said, that Warsh is probably going to be more hawkish than probably some other picks. And the CME Fed Watch tool certainly doesn't think that anything's going to happen to the Fed funds rate, even by April. And if you look at the curve, it goes out and the probability expands towards the summer. But is there a reason for why, just fundamentally for why the Fed should be a little more hawkish than what some people might expect them to be?
Well, so two things there. One is if he does become Fed chair, which it seems likely, I mean, he's supposed to get confirmed and everything, that would be in May. And then even then, the chairman doesn't unilaterally set rates in other forms of policy. He basically gets the most important of 12 votes on the FOMC and kind of guides the discussion and really has a lot of leeway, but he's still not unilateral. So a different Fed chair or kind of a minor shakeup of the governors doesn't necessarily massively change policy. So I think that actually it is rational to not rapidly reprice things based on these expectations, especially anything before May, because again, Powell will be, unless he's removed for cause, he'll almost certainly be in there through May. When we go forward from there, the argument that I've seen him make is that basically technology-driven growth can allow for lower rates. When we think about where price inflation comes from, there's multiple factors, but it really kind of comes down to two main ones. One is debasement, so the growth of the money supply over time has this kind of upward pressure on most prices, and then that's partially offset by the fact that we get more productive, better technology at making those things, but that's uneven. Right. So we're not way better at mining gold. We do get somewhat better at mining gold, but we don't get like remarkably better at mining gold. Whereas, for example, we do get remarkably better at making televisions. Right. The cost of like a television has absolutely collapsed over a 25-year period. It's a very deflationary thing. Most electronics are like that. Anything that you can kind of automate offshore, these are pretty deflationary prices. So they won't necessarily grow in line with money supply. So if you're growing money supply by 7%, but you're getting 5% more productive at making things every year, their price might only go up by 2%. And so what that argument is basically saying is that we'll have enough productivity that even when you have 6-7% money supply growth, that the price increases, at least the way they measure it, in his estimation would be on the lower end. It might be 1, 2, 3%, and that therefore they don't have to curtail inflation as much as they would be the other side of the mandate, which is promoting job growth. The pushback against that is that we've been in a long period of like zero rate policy, that it is healthy to have a price of money, to kind of root out malinvestment wherever it takes hold. And more broadly, that the market should set prices. That having just kind of centrally administered interest rates is itself a problem. Sometimes they can be too dovish, sometimes they can be too hawkish. It's basically a centrally controlled price fixing. But that's the world we live in. So I think it makes sense to assume some degree of dovishness. I think it would strain credulity to think that President Trump would nominate someone who he's not already discussed kind of intermediate term expectations with. So I think that whoever kind of is selected here, and it's so far, unless something changes last second before, it's kind of formally put forth, I think you can assume some degree of kind of upfront dovishness, but that's no guarantee that they're going to be dovish for the rest of, say, President Trump's term is in office or that person's term as chairman.
People have been tweeting about truflation, consumer price inflation as measured by real-time prices. Is that a measure that you follow? Because the price chart has been trending down in contrast to the actual CPI.
It is one of the ones I follow. There's no one that I just take as like gospel. They're all useful data points. When inflation has hedonic adjustments in it, which of course have challenges. The basket can change over time. So if something becomes expensive, people rotate and consume something else in its place, using something slightly lower quality that hasn't really experienced that. If you kind of take a pretty static basket of like the kind of American dream basket, single family home, healthy food, good healthcare, two cars in your driveway, that kind of thing, high quality education, that basket has generally gone up higher than average CPI, because CPI is of course weighed down by all these deflationary electronics and manufactured goods and stuff. The really big component in recent years has been basically rent. So rent, of course, surged during the money printing period from a few years ago, and really since then, there's been this kind of gradual, kind of decline in rents, and a lot of that kind of goes on a lag. So I do think there's merit to say that the way they measure it, inflation is lower probably in this current period than maybe the headline suggests. But that there are other periods of time where it was higher than headline suggests. That basically the headline was slow to take into account things that are happening. So there's multiple different measures to look at. I think they're all reasonable. Um, I think the part I have issues with is some people will be inconsistent. So you'll see people that are, kind of rooting for like much, like they're always complaining about artificially low interest rates. But now some of the same people are saying that they're shockingly too high right now. They need to be way lower. Um, and I just think, people kind of it's funny how people can pivot over time, so quickly.
Okay, I want to just take your perspective on economic growth. Howard Lutnick, Secretary of the Commerce Secretary at Davos a week and a half ago at the WEF, said that he expects 5% GDP growth. Very optimistic, especially given the last quarter read 4.3, I believe. And so that kind of growth may portend higher rates of hiring and job growth overall, which may point to the fact that the Fed may not need to lower rates. Can you just comment on Howard Lutnick's prediction and your assessment of the job market overall?
Well, two things there. One is that the job market doesn't always go in line with GDP. I mean, hypothetically, if you had almost all the GDP growth created by AI, for example, you can get flat to downward jobs while, measures of the economy go up. There's also a challenge where, the GDP calculation, it includes deficit spending. So in many ways, the bigger deficit you run, it pumps GDP numbers. Now, as long as you're talking real GDP, it offsets their measure of inflation. My estimate is that 5% kind of sustained real GDP growth is optimistic. I'd pick a lower figure than that. But I do think that we are in a somewhat run it hot environment. Right now, we're not really oil price constrained. Supply and demand has some degree of flexibility. So we're not seeing high prices there, which doesn't really kind of hold up growth in the way that sometimes in some environments it does. I do think that AI is giving us over time substantial productivity changes. It also gives some challenges, obviously, for people that are on kind of all sides of it. But I would take the under on 5% personally, even though I do think that we're probably above the 2010s and early 2020s baseline average.
Any signs of significant labor market weakness that may incentivize the Fed to cut more aggressively?
So we have inched up from the low point on unemployment. Um, uh, some of the Fed members have talked about how they would like to see it, maybe half a percentage lower. There's no firm target. There's no like hard number that they're aiming for. As long as the inflation, the way they measure it is on, the controlled, they're able to, be a little bit looser. I think and one of the problems I've highlighted both on your program and others is that this entire kind of period of higher rates and lower rates, it wasn't even fully targeting the issue, right? So when we think of like high rates and inflation, we normally think of the 70s, Paul Volcker and all that. And in the 70s, most of the money supply growth was driven by bank lending. So there was like historically a very high rate of bank lending. And that was in large part tied to demographics. The very large baby boomer generation was entering their home buying years for a sustained, period of time. And so it's kind of peak credit formation, peak bank lending, and all that. And so when you raise rates, you dramatically increase borrowing costs and you generally slow down that rate of bank lending. One of the problems we've had, since 2020 and really even a little bit before then, is that we're now in a period where most of the money supply, basically that is more funded by fiscal deficits. That our demographics are now quite aged. We have this kind of very top-heavy entitlement system, top-heavy defense, and then now interest expense as well. So we have very large fiscal deficits and rather subdued lending. So when they kind of raise rates to try to contain inflation, it's not really targeting the core issue because bank lending wasn't like excess bank lending caused inflation. The large monetized fiscal deficits did. Out of all of the Fed candidates, Rick Rieder was the one that kind of highlighted that point the most. He's kind of the most I think knowledgeable on fiscal dominance specifically. But I think that's kind of the environment that we're in. That there's actually a pretty big range of interest rates that you can argue that makes sense because interest rates are not even targeting kind of the core thing that has driven inflation in this particular cycle, which is the fiscal deficits. And if anything, higher rates actually slightly increase the deficits because you blow out interest expense. So yeah, I think that there's a very wide range of credible estimates that someone could say for what is like the ideal target interest rate at the moment, both in terms of targeting maximum unemployment and trying to keep inflation in check because bank lending is just not the issue. And that's really what the Fed targets.
Okay, speaking of interest rates, let's go back to the debasement trade. The 5-decade debasement trade that you were talking about that transpired since the beginning of the 70s coincided with a multi-decade bull run in the bond market. As you can see, the 10-year yield and, of course, the long end of the curve, 30-year as well, collapsed from double digits all the way down to basically zero. And then now we're getting a bit of a rebound in the yields ever since 2021. Are we at a structural inflection point where we have a multi-decade bear market in treasuries, Lyn?
So I think we are at a structural inflection point. I wouldn't necessarily say that we are in a kind of prolonged bear market in the sense that, if you have me estimate are interest rates going to go structurally up over the next, say, 10 years, I would say probably not. My base case would be choppy sideways for quite a while. So I think the part that we have changed is that we're no longer a structural downtrend. There's really not much further to go compared to how we already were. But that doesn't mean we're in an uptrend either. And of course, one of the challenges with bonds is that if you just go sideways in interest rates, their returns aren't that good. So we had this kind of 40-year period of good returns because bondholders got both higher rates and they got that increasing price action from falling rates. Lower bond yields means higher bond prices. And so when you kind of hit zero and then you kind of just bounce around after there and you just head in a choppy sideways range, then bondholders are pretty much just getting paid that kind of low to moderate interest rate. And they're not really, unless they're trading very skillfully, they're not really making kind of price gains from those bonds. So I would say it's a mild bear market in the sense that just a sideways rate market is not great for bonds. But yeah, I don't think that we're going to just keep dramatically nominally losing on bond price. I think the past 5-year period is one of the worst periods on record in like history for U.S. bonds. And while I'm not very optimistic on the asset class, I don't think we'll see a repeat anytime soon of this kind of 5-year period.
Okay, and what we learned from the Japanese JGB yield spike in the last 2 weeks was that some say the same could happen to the U.S. if we have fiscal deficits widening, debt skyrocketing. The Prime Minister of Japan announced new fiscal measures, which some say was partly responsible for the spike in the JGB yields. Is that a foreshadowing, should we say, of what may happen to the U.S. if Trump's administration continues to spend and increase budgets on a lot of things, including defense, for example, $1.5 trillion proposed?
Potentially. I mean, of course, in context, Japan's yields are lower than ours, so they've increased at a kind of extraordinarily rapid rate, but from an unusually low level
Yeah.
compared to most other countries in the world. It is true. Basically, they are in more fiscal dominance than any other country. I mean, over 200%, sovereign debt to GDP, let alone the debt in their private sector, which actually has been over the long term reduced on a percentage of GDP basis. It's kind of gradually transferred from the private sector to the public sector over in Japan. And they are in fiscal dominance, meaning that interest rates don't really help them contain it anymore because if they raise interest rates, they just blow out their government expense, their interest expense even faster than they could, curtail other things. So I think basically what we're seeing in Japan is some degree of normalization. They've been in this unusually low rate environment, and now finally, bondholders are saying we actually want some yield. And the central bank, in order to not have just unchecked currency loss, has stopped doing yield curve control. I think the Japan story is going to be playing out for a long time. I don't think they're going to blow up this year. I don't think they're going to blow up next year. Every country can have these little mini crises. I think generally Japan has a very long runway ahead, and it's large part because they have so much foreign exchange reserves. So in many cases, when a country gets that indebted, they face the very tough choices of do you let bond yields keep going up and then just blow out interest expense and then have like a fiscal spiral, or do you do yield curve control and keep the interest expense under control, but then your currency value compared to other currencies gets killed because nobody wants to hold your currency, your bonds, and they have a third option. Where they can sell some reserves and buy back their own currency. So whenever too many people short their currency, they can kind of blow that trade out and slow it down for a period of time. So I think they have a lot of tools to extend this well into the 2030s is my estimate. And I do think that much of Europe, the United States, Canada, we're all on a kind of similar trajectory as them. But some of us don't have the strengths that Japan has either. Japan has a very harmonious culture. They've had a structural, current account surplus for a very long time. And a lot of other countries are kind of entering this period with way more political polarization, especially in many European countries and in the U.S. And in the U.S.'s case, we're entering this kind of period with a structural trade deficit. So we have a larger twin deficit than Japan has. So it is true that anytime you have a government that puts forth a budget that is viewed as kind of irresponsibly large deficit, you're more likely to get a sell-off in bonds. This, of course, happened. This was the Liz Truss moment back during the gilt crisis a few years ago in the UK. That budget spooked the bond market. Later, the Bank of England they had to cancel a speech on balance sheet reduction and come in and do emergency QE to like keep their own yields from like spiraling because they from the levered holders. You see similar things happen out of Japan where they announce kind of a run it hot type of budget and then that mildly spooks bondholders, but again from very low levels. And in the US, if we actually start pushing very large, much larger fiscal deficits, yeah, you could see a little bit of a bond sell-off. Um, I would separate kind of statements about what we're going to do versus actual budgets. So a $1.5 trillion military budget, that has supposed to go through Congress and everything. And I think that by the time it actually gets through, it'd be different than just kind of what is kind of mentioned on True Social or in interviews. So I do think that over time, U.S. fiscal deficits will be flat to up at a pretty high level. But I'm not necessarily expecting any sort of blowout in the next year or two. And if we do get it, then yeah, that contributes to a run at hot environment. So I'm not exactly a bond bull here. I just think that a lot of the damage is already done.
Okay. Now, speaking of the Japanese yen, I brought this up partly also because people have noticed that there has been a relationship, at least in the last 2 years, between the strengthening of the U.S. dollar versus the yen and the S&P 500. Maybe this is just a spurious correlation. Maybe there's more to it. Can you comment on this?
Yeah, I mean, these things can change over time. I don't have any kind of major input on that at the moment. I do think that for quite a while, U.S. stocks have been the place to be globally. Now, there's certain other markets like Canadian real estate, Australian real estate, until the Chinese real estate bubble popped, also Chinese real estate. There are these pockets where other things were interesting to investors. But for the US specifically, it tends to be our stock market. We have the largest, most diversified companies. We have a pretty big tech focus. Um, and I expect that to continue for some time. Um, and as investors kind of got spooked out of Japanese bonds, they've been going into U.S. stocks, but they've also been going into Japanese stocks. I mean, the Nikkei has had a really good run, really ever since 2012. They've had they're one of the better performing stock markets out there, let alone in their own currency. But even when translated back into dollars, Japanese stocks over the multi-year long term have been doing pretty good. So I do think investors are kind of shifting where they have focus. But yeah, I would let others kind of talk more about that specific correlation.
Okay, well, I'll comment on another correlation here: Bitcoin and the Nasdaq, or the stock market overall. You can see this divergence becoming very stark, and it's been widening ever since basically November. And today's sell-off was exacerbated by, I guess, the nomination of Kevin Warsh selling off alongside metals. Let's comment on that first before we talk about Warsh in more detail. Why has Bitcoin been selling off when the rest of the stock market has not over the last month and a half, let's say?
Well, so in short, there's not been a lot of external demand. Few people woke up in the past few months and decided I want to own Bitcoin. They haven't owned Bitcoin already. So there's very little like new capital coming into the space, as far as I can tell. This past summer, there were a number of treasury companies that got very overvalued. They were ones trading at 3 times net asset value, other ones trading at eight times or more of their net asset value. And so a lot of that had to come out of the market. That excess valuation had to come out of the market. That enthusiasm. So yeah, there has been kind of selling pressure. Then I think there's a little bit of a self-fulfilling prophecy of the 4-year cycle. That basically people said, well, whatever it hits in quarter four of 2025, that's going to be the peak for a while, so they want to get out. I don't think the 4-year cycle really has any more credibility to it in the way that it did in kind of Bitcoin's more inflationary earlier years, where the halving cycle was a much bigger factor. But I still think it has a psychological impact. So I think that contributed to this. We've also seen, many software names are down. So even though the Nasdaq is doing well, a lot of that recently is hardware driven,
Yeah.
as well as kind of the big hyperscalers, and kind of these more pure play software companies have really gotten killed. They're all they were expensive previously, now they're kind of viewed as potentially being disrupted by AI to varying degrees. And it's possible that Bitcoin is kind of caught in that trade. I mean, I know that there were some people spooked about quantum for a while, the quantum risk. I think that is overblown in any sort of investment time horizon. But I have heard from a number of credible institutional sources that basically it used to be to say 5% of institutional allocators would ask about quantum as a risk, and that had jumped to like 30% over the past several months. And the way that works is even if an institutional investor thinks there's a low risk of a quantum computer disrupting Bitcoin security, if they say, well, it's a 5 or 10% chance in, say, a 5-year timeline, then they calculate that in their expected value outcome. So if you expect if there's a 5% chance you get zeroed out or nearly zeroed out by some sort of like, tech that comes out of nowhere, then that kind of disrupts your whole pricing mechanism. So I think there's been a bunch of factors that have done this, and I think Bitcoin has to work through this. But yeah, my timelines tend to be longer than what happens in a given month and a half. But I do think that it is cheap here, is how I would view it.
Is there any relationship whatsoever between Bitcoin's demand and gold and silvers, and as a matter of fact, the commodities overall, their demand?
Well, so one of the theses I've seen put forth is that once gold and silver sold off, it would allow Bitcoin to catch a bid. Kind of like how Bitcoin doing pretty well might have previously sucked some of the enthusiasm out of, say, the silver market, because if someone is interested in kind of hard money and particularly likes the more volatile hard money, um, then previously that would have been people interested in silver, and they've been into Bitcoin or kind of broader crypto. And it's possible that as gold and silver and platinum have done really well, that kind of same hard money crowd says, well, why would I own Bitcoin or crypto when I can own the metals that are soaring? Now, as we've seen, at least in a very small sample, as we've seen a sell off in the precious metals, it's not been to the benefit of Bitcoin. Bitcoin also sold off. So I'm not sure that I would link them much here. I would say that I think a correlation that does matter is that I think that the broader crypto space, there's like a trillion in market cap in the broader crypto space outside of Bitcoin, and I still think a lot of that's overvalued. So I've been a kind of a long-term bear on most crypto outside of Bitcoin and stablecoins, and I still think that's a big overhang. And there are many entities that cross own, so they'll own multiple different cryptos and they'll own Bitcoin. And if those other cryptos start doing poorly, they might have to just deleverage or degross their portfolios in Bitcoin as well. In addition, it's bad for it's at least in the short term, potentially bad for the narrative because there's just more negative news to focus on in the crypto space. You can talk about uh, the negative impacts of meme coins. People can talk around corruption associated with President Trump's meme coin and associated crypto ventures. Some of the news that has kind of come around that. So it kind of tracks all these negative headlines that Bitcoin can get lumped into. If Bitcoin is like virtually separate from that. In the long run, I think it's healthy for Bitcoin for all these other crypto things to kind of stagnate down to closer to their like total addressable market, which I think is pretty small. But in the near term, the intermediate term, while they do kind of melt and stagnate, it's hard to envision that it doesn't pull down Bitcoin to some extent. Now I still think that over the next couple of years, global liquidity and overall just the ongoing so-called debasement trade likely contributes to Bitcoin upside. So I'm still a buyer. I still think it's good to dollar cost average into it. I think it's probably, if we check in 2 years from now, it's probably higher than it is now. But there are some headwinds. And I think one of those is the kind of the stagnation of the broader crypto space.
But do you think, just from a portfolio allocation standpoint, even if global M2 money supply does grow and makes a bid on Bitcoin, would stocks still outperform Bitcoin like they did in 2025? Especially what we're seeing today, we're seeing gold, silver, platinum sell off, copper sell off, the hard metals having a coordinated sell off in reaction to the news we discussed. Bitcoin selling off as well. The resilience of the stock market in light of what we talked about, does that make you more optimistic on equities in 2026 than on Bitcoin, let's say?
I'd say 2026 is a toss-up. If I say 2026 and 2027, my estimate would be Bitcoin outperforms. I certainly could be wrong on that, but that'd be my base case. The way I would put it is that when Bitcoin moves, it tends to move rather decisively, right? So in lately, that's not been good because it's been decisively kind of down. But when it does catch a bottom, and shake out some of these weaknesses. So maybe people get over the quantum risk for a period of time, and they get past the 4-year cycle risk, and they get past kind of the broader crypto contagion. Um, when Bitcoin does run, it can run kind of like what we saw gold and silver do over these past 6 to 12 months. So when it does run, I think probably would outperform stocks. The question is, does that run happen in 2026? Does it happen in 2027? Does it kind of split the difference and start happening in late 2026 and then go into 2027? I don't really know about that timing. So I mean, my approach has always been to be diversified. So I own equities both in the U.S. and globally. I've generally avoided long-term bonds in favor of precious metals, which has served me well. To the extent that I have bonds, I generally keep it shorter term, just for a little bit of cash liquidity, dry powder. And then I've had a multi-percentage slice in Bitcoin. And that's over a very long period of time. That's done quite well, even though it's been weak lately. And I generally find that rebalancing is helpful. So when precious metals are absolutely soaring, and they become overweight in a portfolio, it's nice to kind of trim those back a little bit. When stocks are soaring, I trim those back a little bit. When Bitcoin is soaring, I kind of trim that back a little bit, at least in my liquid portfolios. And that allows kind of structural growth without kind of getting caught up too much in any one asset class.
Moving on now to critical minerals. Just today on the 2nd of February, Trump announced the creation of a critical minerals reserve. Today, we're launching what will be known as Project Vault to ensure that American businesses and workers are never harmed by any shortage. What does that look like in practice? You can't just turn on a critical minerals mine overnight. So that's part of the question. The second part is whether or not this announcement has any impact on your investment thesis overall.
Well, for the most part, no, because this is less of a macro scale, thing.
Yeah.
It's more of a kind of a commodity specific thing. I'm structurally bullish on most commodities in general.
Okay.
So certainly it doesn't really hurt any of the theses that I'm operating under. Obviously, people, many people in your audience or your investor base are more specifically in mining and mining stocks. This can be very dramatically important for many of those. I would zoom out and say broadly speaking, we are now an industrial policy, meaning that we're not really operating on free market principles. We're operating more on like mercantilism, and we're operating more on some degree of kind of top-down, uh, things that are happening now. And that often happens during fiscal dominance. So that happened back in the 40s and 50s. Um, and I think that's really kind of what the 2020s and probably 2030s end up looking like is that there's some kind of just more top-down strategic stuff happening. So they've been taking stakes in kind of mineral companies. The whole tariff policy has been kind of very kind of top-down, trying to fix the trade deficit and things like that. So I do think that this kind of thing is going to keep repeating. I do think it's rational for any large country to try to have stockpiles of critical minerals that can last a long time. I think they should have stockpiles of uranium. They should have stockpiles of many types of rare earths, because the trend that we've been operating under has been this trend of globalization. It's kind of this view of like the end of history, especially after the fall of the Soviet Union. It's like, okay, we're kind of operating under this new kind of a rule of law in the world. But as certain imbalances kept growing, and as certain powers kind of grew, we are entering a period now where both policymakers and those who run corporations are interested in more resiliency in their supply chains, redundancy, which is on average costlier because globalization and single points of failure, while they work, are disinflationary. But then when you have to start, building kind of duplicate systems, and you have to assume a more adversarial mindset, and things kind of get rapidly shut off, potentially. That's more inflationary, more redundancy. But I do think that's a direction that the world is heading in, and I think that it should head in the sense that if you have any sort of meaningfully impact on running a country, I do think it's relevant to have stockpiles of things that your economy really can't live without for any material amount of time.
Two more questions. I'll let you go, Lyn. So that leads me to my final point, which is globalization. So as you probably heard during the Davos conference at the World Economic Forum, the several world leaders, including Mark Carney of Canada, announced that perhaps globalization is fading and a new world order is going to happen in which there's going to be less of it. Now, what happens when there's less globalization? We talked about disinflationary impacts from globalization being an impact that may be fading. Are we talking about the reverse then, where we have more inflation? Are we talking about investing in, domestic manufacturing? What does that mean practically for the investor?
Well, so it means less disinflation from globalization, so less disinflation from supply chains. It tends to be more efficient to just say, okay, we're going to put all of our manufacturing in this country, and they're going to specialize in manufacturing, and this other country is going to specialize in this, and everyone's, you have single point of failure everywhere. As long as it's working, that's a very efficient system. But of course, it's fragile. So when you build a more redundant system, it's less hyper efficient, but it comes with more resiliency. And I do think that's the world that we're heading toward. If you measure globalization as percentage of annual kind of world trade as a percentage of world GDP, I do think we're going to enter a period where that is more flat, not increasing as the way that has been. It could even decrease for a period of time. But let's just say even flat means you're not necessarily deglobalizing, but you're not really globalizing anymore. And that is a trend change. Kind of like how we talked before about if bonds go from the yields going down to just going sideways, that is a structural change. And I think we could see a similar thing with globalization. Now, there's still other parts of disinflation that can happen. We talked before about how AI can be, disinflation on some areas, kind of like how blue collar, automation of manufacturing and globalization. Those have been disinflationary mostly on goods, and where we're likely going to increasingly see AI disinflation show up is like decreasing costs of like kind of services. White collar types of services and things like that can sometimes be just iterated way faster in AI. Not necessarily replacing workers, but making so that each worker can do way more of what they can do. Kind of like how automation lets a one train kind of car maker, instead of making cars by hand, you're overseeing the robots making cars. And so per worker, you have more cars coming out. I think that accounting services, editing services, translation services, people become more like managers of the automation, doing a lot of those things, which is disinflationary in a good way. But of course, it can be disruptive. So I think you can get one type of disinflation slowing down, like disinflation of like hardware. We've seen soaring in many cases electronic prices because of bottlenecks. That period of disinflation could be, partially behind us, but then other types of disinflation, like software disinflation and things like that, can still be with us. So I think it changes the categories where we're going to see disinflation. And I do think that we're entering a more multipolar world. I've been writing about that since at least 2020, probably, somewhat before then, that we're entering a world that is not just entirely centered around the US. We're entering a world that's centered, partially around the US, partially around China. If you asked me a few years ago, I would have said Europe, but they kind of handicapped themselves on the energy side. So really, kind of the two big poles are the U.S. and China, with a handful, India and Brazil, and to some extent Europe are also sizable poles in all of that. But I do think we're entering a more multipolar, redundant world with more adversarial thinking tied into it, which is also that contributes to why precious metals are attractive, because instead of sovereigns around the world holding treasuries, some increasingly they say, well, I want to hold something that can't just be shut off with a stroke of a pen. I want to hold metal in my own borders. And Bitcoin's still a small market, but Bitcoin also has that trait where it's a decentralized network, so it can make for a decentralized settlement and self-custody. So I do think that we're in a world where you want to kind of think about these things rather than kind of assuming that systems work as they always have.
I have one final question for you. I promised you two final questions. My last one is, you have a sci-fi book coming out. You can tell us a little bit about that, but more broadly, I'm curious to know which, I guess, sci-fi predictions from either the current time or I guess from your childhood and my childhood are you most looking forward to seeing come to fruition at some point, if they ever do?
Yeah, so I have a sci-fi book coming out in March, so
Yes.
people can check that. I'll have announcements on social media, my website when
You
it's
have a
out.
name for it yet? Not yet?
The Guard incident.
Okay.
So and it's near future, so it's not a space opera. It's set on our planet. One of the technologies I kind of focus on a lot, and it's funny because the recent news of all these AI agents kind of talking to each other on social media, that's commonplace in my book, where basically the kind of the internet is flooded with bots, not just in the spam sense, but in the sense that just bots become a more commonplace part of our life. Um, the part that the book explores, it's more on the cutting edge there, is more like gene editing. So bioengineering soldiers and things like that. That's kind of spookier stuff that the book explores. But I think the more baseline stuff is just AI becoming more commonplace. In fact, part of why I kind of got myself to write it, I've been putting it off for a very long time, just because I've had my hands full with everything else. But because I see that whole technology area growing so rapidly, I was like, if I don't write my book, it's going to become historical fiction. It's not going to be sci-fi. So it's like I have to get it out at a reasonable time frame. For me, I think that in addition just to seeing just AI in general help us with a lot of things and increase our productivity, um, I like the return of hardware. Basically, kind of this renewed interest in the physical side of computation. So I've been happy to see the kind of the renewed interest in GPUs now, that more recently the renewed interest in memory. Personally, I would like to see more aerospace stuff. I've been excited about the work that SpaceX does. Also, I've been excited to see, especially out of China, some of the flying cars, these kind of technologies that have kind of
Yeah.
finally kind of catching up to things that we might have been thinking about when we were kids.
Right.
I think that at a commercial scale, it's still somewhat a bit away, but I do think that over the coming decades, we'll see a little bit of a return to some of these more hardware focused things, and not everything's just so software focused.
Yes, I am looking forward to the live action version of the Flintstones, but without CGI. So let's see let's see if that happens soon. All right. Well, thank you, Lyn. Besides your upcoming novel, where else can we follow your work?
People can check that on lynalden.com, and they can also check out Broken Money on Amazon or elsewhere. Thank you.
Okay, good. We'll put the links down below, so check out Lyn's work in the links in the description. Thank you very much again, Lyn. We'll speak again soon. Take care for now. Thank you for watching. Don't forget to like, subscribe.